Welcome back, everyone. In this video, we're going to go over 4 of the best dividend ETFs on the market right now. These ETFs offer excellent diversification to a variety of stocks for a very low cost. And the funds we're going over in this video have different investing strategies and focus on multiple areas of the dividend market. We're going to analyze ETFs focused on long-term dividend growth and others who provide investors with some high current dividend income. And dividend investing is one of the purest forms of passive income. Once you make your initial investment, you can then sit back and collect your growing quarterly cash flow without doing any extra work. And with dividend ETFs, the entire process only gets easier because of all of these funds. They are diversified, they own multiple different companies from various sectors, so you never have to worry about 1 or 2 dividend cuts impacting your overall portfolio. And now before we jump into that first dividend ETF, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos. And the first dividend ETF we're going to take a look at in this video is ticker DGRO, which is iShares Core Dividend Growth ETF that currently trades for $50 per share and is up 43% over the trailing 12 months. This fund has a yield just above 2% and holds around $18 billion of assets under management with an extremely low expense ratio of 0.08%. And the goal of this fund is to offer low-cost exposure to US stocks focused on dividend growth and companies who have a long history of sustained dividend growth and are broadly diversified across many different industries. And we can see that this fund has posted some incredible performance. And over the past 5 years, it's averaging 15.5% total growth, which is absolutely incredible. You're getting some long-term share price appreciation plus a 2% growing yield every single quarter. And if we take a look at an investment of $10,000 5 years ago, it has now grown to over $21,000 at this current point in time. So your money's more than doubled in a 5-year span if invested in DGRO's ETF. And right now, this fund holds 391 different stocks, and the yield is sitting right around 2.1%. And if we take a look at some of the top holdings, this fund is diversified across many different sectors and different types of dividend growth companies. So number 1 and number 2 are Apple and Microsoft, the 2 largest companies in the S&P 500 who offer a lower current yield below 1%, but are growing that annual payment in double digits every single year. Then 3 and 4, we have Pfizer and Verizon. These are higher yielding companies who offer a current yield above 4%, but their annual dividend growth rate is in the low single digits. And then finally at number 5, there's Johnson & Johnson, who sits right in the middle of these 2 differences with a current yield of 2.5% and mid-single digit average annual dividend growth. So right away we can see, even within the top 5 holdings of this fund, we're getting a ton of variety with some high yielding companies, some low yield, high growth companies, and some middlemen like Johnson & Johnson. And to round out the top 10, we have companies like JP Morgan, Procter & Gamble, Home Depot, Merck, and Cisco. So all 10 companies are some of the strongest dividend growth names on the market and provide you with broad exposure to many different sectors. And if we actually take a look at the sector diversification, we can see that information technology makes up around 20% of this ETF, financials are at 17.5%, healthcare at 17%, industrials at 12%, and consumer staples right around 9.4%. So once again, the largest sector only makes up 20% of this overall portfolio. So even if one sector takes a downturn, your overall portfolio will not be too harshly impacted. And this fund, like we saw, owns 391 different stocks, so you are broadly diversified across many different names on the market. And now if we continue on, we're going to move into the second dividend ETF in this video, and that is ticker SCHD, which is Schwab's US Dividend ETF. It currently trades for $75 per share, and over the past 12 months, it has grown by 54%, and this fund has assets under management of over $21 billion, a very low expense ratio of only 0.06%, and a current yield at 2.8%. And if we take a look at their website, this Schwab US Dividend ETF is focused on tracking an index focused on quality and sustainability of dividend income. And this invests in the stocks that have a fundamental strength relative to their industry peers based on financial ratios. So this fund is a little more selective in the companies that they own. They are not just investing in all of the companies who pay out a growing dividend, rather they're selecting the ones who have better financial ratios relative to the peers in their respective industry. And if we take a look, over the past 5 years, they have posted some incredible performance, growing by 16.3% annually, which is absolutely incredible. And since the fund was created, it's been averaging over 15.4 annual return, which once again is a massive growth rate for an ETF. And we can see that right now it has a yield just below 3%, so higher than the first fund we took a look at. And if we take a look at some of the top holdings, we have Home Depot, Texas Instruments, Amgen, Broadcom, Pfizer, Cisco, Pepsi, and IBM. So right away we can see that the top 10 holdings in this ETF are much different than the first fund we took a look at. These are all blue chip companies, and SCHD has selected these individual names because they have stronger financial ratios relative to their industry peers. And one thing to note, that this fund only invests in 104 different companies. So compare that to DGRO, who owns 391, we can see that DGRO takes a much more diversified approach to dividend growth investing, rather than SCHD, which has a more selective and focused approach to owning the best dividend growth companies on the market. Of course, it's all relative, and we'll never know exactly which one will outperform over the long term, but it's important to note what type of fund you're investing in. And if we take a look at this ETF's total holdings, 25% come from the financial sector, 18% from industrials, 16% from consumer staples, and tech makes up around 14% of the total weight in this ETF. So again, different sector diversification from the other funds we're going to go over. So definitely another great ETF to take a look at for your own portfolio if you want a more selective approach, own less equities, and more of the stronger names within each sector. And now we're going to continue on to the third ETF in this episode, and that is ticker VIG, which is Vanguard's Dividend Appreciation ETF that currently trades for $153. Vanguard is the pioneer of the low-cost ETF sector. They're the biggest name on the market, and this fund has around $57 billion of assets under management, and over the trailing 12 months, it has grown by 37%. It has a yield at 1.5% overall, and once again, a very low expense ratio of only 0.06%. And VIG is a dividend appreciation ETF, and it owns the companies who have a strong track record of growing their annual payment to shareholders each and every year. And over the past decade, this has been a consistent performer, averaging a total return per year of 12.5%, and over the past 5 years, its annual return has climbed to 14.8% overall. And a $10,000 investment made into VIG 10 years ago has now grown to over $32,000, so more than tripling in a matter of 10 years. So this fund has proven to be a great holding within many dividend investors' portfolios. And if we take a look at some of the top stocks, we can see they have JP Morgan, Johnson & Johnson, Microsoft, Walmart, and United Health round out the top 5. And this ETF is different. The largest sectors include industrials, healthcare, consumer, financials, and even some technology at only 13%. So our first two ETFs had larger weightings in the financial sector, rather VIG has a largest holding in industrials. And this fund owns 247 different stocks. So once again, I want to stress the point that not all dividend ETFs are created equally. DGRO owns 391, SCHD owns 104 companies, and now VIG owns 247. So although they are all focused on dividend companies, they have different strategies on which stocks they want to own within their portfolio. So you actually have to do some research and make the selection to which one you believe is best for you. So Vanguard's Dividend Appreciation ETF is definitely another option to take a look at for a well-rounded, nicely diversified dividend portfolio. And now we're going to move on to dividend ETF number 4, the last one we're going over in this episode, and that is ticker SPYD, and this is an S&P 500 high dividend ETF that currently trades for $39.52. And over the trailing 12 months, it is up over 50%, and this fund has around $3.13 billion of assets under management and a very high current yield of 4.75%, and once again, a very low expense ratio like all the others at 0.07% overall. And if we take a look at the fact sheet, this is SPDR's high dividend ETF, and this ETF is designed to track the 80 high dividend yielding companies in the S&P 500. So if we take the largest by market cap companies in the United States, and this fund chooses the 80 highest dividend paying, and that's how this portfolio is broken down. So this is for the investors who are closer to retirement and want to give up some long-term share price appreciation in order to get a higher current income coming out of their portfolio. And we can see right now, this fund has returned an average of 9% per year over the past 5 years. And since it was created back in 2005, its average annual return is at just around 10%. So you're still getting some nice growth from this ETF, even though it's focused on high income producing assets. So this is different from the other three because the other three funds provided higher 14, 15, and 16% average annual returns. So this one, you are giving up some long-term growth in order to collect that higher passive income every single quarter at this current point in time. So if I think you're approaching retirement, if you're 5, 10 years away from that goal, this may be a fund to start building up within your portfolio. And we can see right now, some of the top holdings include Seagate, HP, Hanesbrand, Invesco, People's United Financial, and many more. And one fact I really like about SPYD is that the largest holding only makes up 1.5% of the entire portfolio. So across all 80 individual stocks, you are highly diversified, and because these are high dividend companies, there is a greater risk of a few dividend cuts, but because each fund is capped at around 1.5%, if 1 or 2 cuts do come in, your overall portfolio will not be too harshly impacted. And this fund will just kick out those ones that made the cut and replace it with the next in line, having a very high yield. So going forward, I really like this ETF. If you're at the point in time where you're close to retirement, it comes with a very minimal fee, and you can make some high passive income coming into your portfolio every single quarter to pay off all of your monthly bills. And if we take a look at the sector diversification, we have around 24% in financials, over 18% in real estate, 14% in energy, 13% utilities, and tech makes up around 6.7% of this ETF. So definitely another option to take a look at within your portfolio if you want exposure to some high current dividend income rather than some long-term dividend growth. So all dividend ETFs are not made up the same. When people think about dividend investing, they think of one single category for every stock that pays out a dividend. But like we saw across all 4 ETFs, they all hold different types of companies, they own different numbers of stocks, and they all have a different dividend investing strategy. We have some that are focused on companies who continue to grow their dividend every year, some who show companies who have paid out a dividend with very strong fundamentals relative to their peers, and then of course the last one was an ETF focused on the 80 highest yielding companies. So you can find so many different options out there for your portfolio. You have to pick which one you believe fits best with your personal investing strategy, and that's the one you should choose and throw your money into. And in no way do I think it's bad to own more than one dividend ETF. All the fund expense ratios are extremely low. Some people may believe that's over diversification, but if you don't know exactly which one you want to own, I don't think there's any problem with picking 1, 2, or even 3 of these funds for a nicely well-rounded dividend portfolio. So now we're going to wrap up the video. I want to thank you for watching to the end. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.